Welcome to Living in a Double World. My name is Ana Maria Quevedo.
And I'm Feliz Quevedo. Once you have everything needed to request a home loan, you are ready to buy a house.
Make sure you understand what type of loan you're getting, what are the terms, what's the interest rate you're paying, and all those goodies.
Right. A mortgage is basically something that's actually a loan that we put a family, it's a home loan, and it goes for 30 to 40 years. And it's a reason it's a longer term than a car loan, which is usually for like 5 or 4 years, is because it's a large sum of money. It's amortized over 30 years, which means that your payment is calculated over the term of 30 years. Interest rate's about 4.5%, 4.25% right now, so the payments are very good. Somebody that pays cash for the house is not going to get a tax deduction. So buying a house, yes, it's the biggest debt that I put somebody in, but it's the best kind of debt that I put them in because they can go to their accountant at the end of the year, their CPA, and take the interest that they earn on the home and the taxes and write it off. So even though I've put them in debt for 30 years, I actually tell them that when they finish paying their car loan, they can actually take the extra $300 and put it towards their home. So even though the loan's for 30 years, and they can pay the house off in 10 or 15 years. And if they do that, their interest rate actually doesn't even behave like 4.25%, actually behaves like 3%, because you've actually given less interest to the bank and you've actually paid the principal. They bought a house for $100,000, so their job is to pay the $100,000 off. If they send extra to principal, they'll pay that off. So mortgage, if you just pay the minimum, then yes, the bank will make a certain amount of interest for 30 years. So mortgage is nothing that a way for you to obtain a home by having on a $100,000 home, your payment would be probably about $800 at 4.25%, which is amazing because most people are paying $800 to $900 on an apartment. And then if you calculate that $1,000 rent, multiply that by 12, that's $12,000 going to thin air. And most people come out of college, they're renting for 10 years. That's $120,000 that they've given to some apartment complex. They could have paid cash for that house by then. So I teach a lot of my first-time home buyers, why is it important if you have the down payment and you have the money and you have a good credit score, buy a small house and then upgrade to a second house 5 or 10 years later. But a mortgage is a very, very important loan for a family who's getting a home. Over the term of 30 years, the bank is going to charge you certain interest based on interest rates. So the interest rate's 4.25%. So the bank is loaning you that money up front so that you can pay the seller because you're the buyer buying the house. And the seller is selling the house. And the seller will take that money and use it to buy their next house. Okay? So the principal, so in your payment of $800, about $600 will be interest to the bank, and very little, like about $200, might go to principal. Okay, in that $800 amount, let's step back a little. A little bit of it, about $100, will go to taxes, and maybe $50 goes to insurance, because the house has to be insured to make sure that in case there's a fire or theft or flood, that the bank wants to make sure the house is insured. So you have insurance, and then because your house is in the Comal County or Bexar County, we want taxes. The county wants taxes because of the roads and all of that, the school taxes. So taxes is added to that. So it's basically a combination of all those 4 things: principal, interest, taxes, and insurance. We call that PITI. That's in our terminology: principal, interest, taxes, and insurance. PITI. And that's kind of like the language that we use in our mortgage industry.
We wish you blessings and guidance to all.
Till next time.